all-new Ghost Pepper Chicken Fries at Burger King. Our delicious white meat chicken fries have been taken up a notch with Ghost Pepper spice added to the breading for ultimate flavor and heat. Ghost Pepper Chicken Fries have arrived at Burger King. Available in 8 or 12 pieces, but for a limited time only. Full menu at burgerking.ky.
Hi, I'm Wardley Connolly, a Flow technician and a member of the Flow family. Every day, myself and other members from Flow team are out in the community working to better serve you. We are expanding our network and growing the fiber family daily. As we upgrade fiber optic throughout the communities, we are committed to ensure a better, more reliable internet experience to everyone across the entire islands. I'm inviting you to join Cayman's largest and most reliable internet. Visit one of our stores near you or go online to discover flow.ky. We look forward to serving you.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
To keep our records up to date and to ensure seamless communication, the Cayman Islands Chamber of Commerce Pension Plan encourages you to review and update your beneficiaries and contact details, including your email and mailing addresses. You can update your contact information by logging into the member portal or by contacting us at 745-7630 or via email to admin@pensions.ky. Remember to act now to ensure we have the most current information for you. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and a warm welcome to Money Sense. This morning I'm delighted to be joined by a good friend and investment manager, Richard Mundinger. Richard is a CFA charter holder and is visiting Cayman on vacation, but has gamely agreed to spend 30 minutes with us, giving us his perspective on markets, economics and investing. Richard has his own investment advisory business, a registered investment business out in Arizona in the States, a company called RMH Investment Management, and manages over $68 million in discretionary assets for investors. With that, good morning to you, Richard. Welcome to Cayman, and thank you very much for joining Money Sense.
Good morning, Simon. Thank you for the very good welcome.
Well, it's downhill from here. It's going to get tough questions for you. You know, we've known each other for a number of years, so I will not let you off lightly. Let's start off with perhaps the obvious one that's on a lot of investors' minds. They've just experienced 2023, where almost anything that they owned in their portfolio went up, whether they had equities, whether they had bonds. Everything seemed to go up. It was easy. You didn't need to make a lot of decisions to make 10, 12, 15%. So the natural question is, can that continue, or are we in for a hangover as 2024 progresses?
Simon, I think we need to go back a little bit before the start of 2023. The consensus, as you were talking about, as we were exiting 2022, every single economist was forecasting that 2023 was going to have a major recession. There's going to be 3, 4, 5, 6 rate hikes, and it was just going to drive the economy into recession.
Well, we had the rate hikes, didn't we?
We certainly did. And guess what? Someone called a party, called a recession, and no one came. And one of the things that I was taught way back in the day was that it's hard to have a meaningful recession correction when all of the companies are making profits. And if we fast forward to this year, all of those same companies are still in the position of making profits despite, the 5 or 6 rate hikes and, U.S. interest rates sitting about 5 to 5.5% on the cash rate for borrowing.
But it seems, I guess a lot of people look at that and go, are these sustainable, these profits? Because they were great last year. They seem to have been going up. Profits have been fine for many, many years. We've all sort of learned or grown up over cycles where things don't just continue going okay. Is there not going to be that turning point where there will be some sort of recession, mild or severe? Won't that happen?
Well, we will always have a recession, and there will always be one around the corner. If you go back to what I would call the earliest recorded time of good data, 1929, every year since 1929 going forward, there's always been very well-rounded reasons to have a recession that year or next year. And guess what? We've had them. We've had wars in between. We've had bad decisions in between. Yeah, and if you look at the shape of the overall U.S. or the Canadian stock market, it's up with pullbacks. And I look forward in 2024. I see that the companies will still be,
making their profits. And if you're making the profits, it's, we will continue to have earnings growth. I hate the following sentence, but I'll bring it out. This time is different. Well, it's not quite, but it is. What is really unique at this point in time right now is just the advancement in computer, technology processing power, or something called artificial intelligence, of what we're just at the absolute start of. And in this country, the U.S., we're facing demographic issues. There's a missing 5 million workers, yet earnings are still going up. You look at China, they've got massive demographic problems. You're going to see a massive use of robotics in China. And to me, when you start putting in technology in place of, some human labor, because humans can never be replaced, you don't have sick days. You don't have people taking time off. And I think unless there's something significant to happen that we don't know at this stage, it's
Terminator. It's Terminator. That's sorry.
Yeah,
slight digression.
Yeah. Unless something like that happens, I think we're going to have our ups and downs, but the trend is going to be up.
I just wanted to bring up the Terminator on the radio. It's been years since I've been able to, so thank you for allowing me that. I guess, look, you deal with individuals. You help people manage their personal finances from an investment perspective. There must be people you talk to who go, but Richard, I'm scared. I'm scared that we've done 15% last year, or 20%, whatever the number is. We don't do 15, 20% every year. Surely this year, let's be a bit more careful. Let's just take the money off the table. Let's not take the risks. How do you reply to that? Because I guess I'm hearing you say that you get recessions, but they're just part of the natural course of things. Things still go up over time. So how do you respond to that human emotion where people just don't want to have the fear of things going down?
Simon, that's a really good question. We build portfolios for our clients on a total return basis. We drill down to find out, what they're trying to achieve with their portfolio. However, the biggest question we ask is, what are your spending patterns for the next 1, 2, and 3 years? And we found that once we can put aside monies for spending patterns over 1 and 2 and 3 years, unless there's something cataclysmic happening, we never have to draw monies out of the equity portion of the portfolio. So it doesn't count as a double-edged sword if markets go down and we're, having a bond mature or having a U.S. Treasury mature, or, there's cash in the portfolio. We program it such that we don't want to be pulling monies, if at all possible, during bad times.
So you're saying people should focus on the longer-term trend of investing, and to the extent that they can put money aside for spending purposes or for emergency purposes, the fact that you might have delivered 15% last year and maybe you get a -5 this next year, but you're better off getting a -5 so that you're prepared and in the market for when you get another 20% rate year.
Yeah, exactly. The problem, what we noticed in 2008, 2009, it wasn't the fact that the S&P cratered, down 50% in December of 2008. The problem was, for a select few clients, was that they panicked. And then, we received instructions to get out of the market. However, they didn't listen when we said it's time to get back in the market. And the next thing you know, it's 6 months, 1 year, 2 years after, they're still not in the market, and they've decided that we don't know what we're doing and we get fired, which is just fine. I've got an underlying belief that within reason, markets, behave, and it's only at the severe points of an inflection point when people panic, and really our job in the private client is to make sure you're not panicking.
How do you stop people panicking? Do you almost say to them, don't tie your hands and just don't, I'm not going to answer the phone to you?
This is classic, Simon. I'm glad you asked. This is so funny. I phone up a number of our widows that are 75, 80, 85 and ask if they've got any concerns, and I phone a few others, and if no one has any concerns, that tells me the entire client base has been listening to us and they're not panicking.
Yeah.
So conversely, if we get 2 or 3 unsolicited calls from some of our clients that are worried, then we need to listen as to what they're worried about, and quite frankly, sometimes or most of the time we find out it's not due to the markets. There's something else in behind that was just totally out of their control, whether it's an illness or a child ran into some issues, which at their ages they're called grown-ups, but there's always something else that's putting stress on them, and it's not necessarily the portfolio or the portfolio performance.
Yeah. Now, we're talking about markets and what they might do this year. One thing that I guess is in a lot of people's mind, you've said don't panic, don't worry about the very short term, invest for the longer term. Things generally work out, and history has shown that. There's no doubt about that. But still, psychologically, it's difficult to get over that. Oh, I don't want to see a loss. Equally, the protagonist who's disagreeing with you in a sense will say, things are expensive now. I read an article saying that the PEs are at record highs, or the other investment multiples are quite high. Surely this is not a good time. There's lots of ways that people can express their fear or their concern, but that's a very common one when you're watching TV shows that have investment professionals on. People talk about valuations, and so when someone says, "Oh, valuations are high," that puts a bit of fear in people as investors.
Good observation. One of the interesting things that I read just a period of time ago, probably in the last year, and it caused me to sit up and think, was that people want to compare the valuations today as of the valuations in, say, 1950. 1950, we're coming out of a world war, or 1929, when we're just heading into the Great Depression. You really can't compare valuations across the decades because different things happened. So let me just use a basketball example. You can't compare Jerry West, who was one of the best players of his time, to Michael Jordan, who is one of the best players of his time, to LeBron James, who's clearly one of the best players of his time. They're all different. They were all playing in different societies, different times. And I'll just use LeBron as an easy example. He's 38 years old. Still looks like he's chiseled.
Like me, then, in terms of the physique. Yeah.
Simon, I couldn't agree more. That little six-pack that you show off all the time. But then when I read about what LeBron's doing for his eating, what he's doing for his sleeping, there's a whole slew of things that he's doing that we as a population should be doing, but we're not. So today's professional athlete is way more equipped to handle the stresses of the flying. They get private planes, this, that, and the next thing. But if we get back to investing, there's just different times. If you take the period of 1929 and what caused the depression there was that you could buy a stock with 5% down and have 95% leverage. Well, nothing good happens with 5% down and 95% leverage, and we found that out the hard way. But then if you go forward through the decades, you can just see the rise of the Dodd-Graham era, where they talked about deep value. You want to have a margin of safety and this and that. That's good. There was a much smaller amount of money investing at that time. And then you can go into the 70s and the 80s, and you start to see the rise of the mutual fund. You start to see the rise of various defined benefit plans or university endowments, which all of a sudden have a time horizon in decades, not years. And you have money flooding in. Now, fast forward to today, you now have the same endowments, the same pension plans, but before, where they had hundreds of millions, some now have 500, 600 billion. Norway's going to go through $1 trillion. Well, that money needs a home. So whether you invest it actively or passively, it's flowing into the market. And I just think that it's different times, and I'll address your PE thing right after our break.
Okay. Well, look, with that, we will take a brief break, but do join us again in 60 seconds as we continue our conversation on investment themes and topics with Richard Mundinger.
To keep our records up to date and to ensure seamless communication, the Cayman Islands Chamber of Commerce Pension Plan encourages you to review and update your beneficiaries and contact details, including your email and mailing addresses. You can update your contact information by logging into the member portal or by contacting us at 745-7630 or via email to admin@pensions.ky. Remember to act now to ensure we have the most current information for you. The Cayman Islands Chamber of Commerce Pension Plan. We're here for you.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense with Richard Mundinger. Richard and I were discussing valuations just before the break, and you ended with the immortal words, after the break I will discuss price earnings multiples. So please, Richard, lead us away. This is what we've been looking forward to over breakfast as everyone's digesting their Weetabix. Take it away.
For those of you that aren't students or don't specialize in this business, PE
Don't look at me like that. You're looking at me too carefully when you say these words.
PE multiples are just price divided by earnings. And there's a theory that, if you're Warren Buffett, you want to have a 6, 8, or 10 price to earnings multiple, and you feel that that's a margin of safety. You want to have a dividend, and that certainly is one style of investing. If you're, that's sort of more along the lines of taking a magnifying glass and looking over the financial statements, very, very, acutely. That would be called value investing. If you want to look at growth investing, which we seem to be is all the rage right now, as you can see what's happened with artificial intelligence and a number of the leading artificial intelligence stocks like NVIDIA, Microsoft, Apple, Facebook, or I guess that's now called Meta. People are willing to invest in those companies with much higher price earning multiples of, maybe 20 times. Maybe 24 times, because they are looking into the future to see what the future growth is. And that is the interesting point. So quite simply, when you're looking into the future for future growth, at some stage, you can't keep growing at the same breakneck, the same fast pace that you were, and your growth slows down, in which case your company then turns into a value company. And then sometimes your PE multiple, shrinks. The other little wrinkle in this is, and it's too easy for the journalists to mess this up, but they always look at backwards PE multiples. And if you take looking at last year's earnings with next year's forward growth, you will get an absurd PE multiple of in the 30s, 40s, 50s, 60s, sometime even 100. And while that might not make sense, I think it makes more sense to look at forward earnings divided by, forward pricing, and I think the market generally gets it right over time. However, those that have practiced in the market for a long time know that there can be significant periods of time when there is inefficiency in market pricing, and no one knows when that ends until it ends.
Which leads me on to a topic: consensus. We started the show by saying there was the general consensus at the beginning of 2023 that there must be a recession in 2023. The Fed's going to cause a recession, whether it wants to or not. And perhaps, ironically, the Fed's incompetence probably prevented it from causing a recession. It didn't prevent the inflation problem by being incompetent and late, and its lateness to the party has probably stopped it causing a recession. But the general point, though, is that consensus can be a double-edged sword, right? Where do you think consensus might be wrong right now that you think people should be mindful of?
Oh, that's crystal clear. At the end of last year and the first few days of this year, you couldn't find a Wall Street expert that wasn't talking about 5 to 6 rate cuts. We were of the opinion that there might be 1 or 2 at the most, and once the election gets in sight for the U.S., sometime in, that's the second Saturday or the first Tuesday in November, whatever that date is, sometime after September, there'll be no Fed actions unless there's a real problem. And
that's because traditionally the Federal Reserve doesn't want to be seen to be meddling in politics by making a rate cut, thereby potentially stimulating the economy and favoring one side versus the other.
Correct. So we hope that's not the case this time, because the world would love to see just a fair, run election, not only in the U.S., but, around the rest of the world. But back to that Fed thing, the problem stemmed back from mid-'70s when Arthur Burns was the chairman of the U.S. Federal Reserve, and he at first got ahead of inflation, but then I think Nixon, who was president at the time, put pressure on him to lower the rates to stimulate his reelection. So he did. End result was we now have inflation popping towards 15 or 18%, and it's the worst ever. Volcker has to come in and then drastically raise interest rates. Imagine this, you could buy 30-year U.S. Treasury bonds at 15%, and if you held those, you would have made a fortune.
Yeah.
And I think that today's Federal Reserve was influenced politically when they used that word called transitory inflation. I'm not sure who that goes shopping with their own money found any sort of transitory inflation. And they were late to the party to raising. The good news was is they took it up in big steps. I would have done it at 1% moves just to show that I was serious faster. They went up at 0.75%, but still it got the job done. And now they're going to make, I think, very, very clearly, they're going to try to make sure that inflation does not happen on their watch. And if I'll just say one other thing on inflation, it's going to be a lot slower than people think for it to come down.
So what you're saying then is that the Fed, if I'm reading you right, the Fed, while it would like to, if the economy started to weaken, it would like to help stimulate, it doesn't want to go too early and risk causing inflation to start rising again, thereby making participants look as though they've lost control again.
Yeah. They're walking on a tightrope. On one hand, this happens and you get inflation back. On the other, they cause a recession and massive job unemployment. What I think is interesting is that, after COVID, we're still missing roughly 5 million workers. All of the foreign workers in the U.S. Have all got back to their jobs, but there's still 5 million domestic workers that haven't come back. And I think that technology will be stepping into that gap, whether it's robotics, advanced technology, you name it. It's going to come and help things.
Yeah, I see that. I guess the other challenge that we might be facing is we look at geopolitics, and when Russia invaded Ukraine and COVID clearly impacted transportation networks and delivery systems and just generally disruption. And that causes inflation, because if it costs more to ship something around Ukrainian or Russian airspace because of conflicts, that's a problem. And we saw that. COVID clearly proved that. I guess that was the Fed's element of transitory. It thought, well, this will last, this will pass. But then inflation expectations become ingrained, and people expect the inflation that they've just had as opposed to accepting it's going to decline. But we do now have, again, another Middle East crisis whereby there is disruption to shipping, there's disruption to the cargo vessels, the oil vessels, and that means that stuff from Asia that's trying to get to Europe now no longer is going the quickest route through the Red Sea. It's now going all the way around South Africa, which adds costs to goods and prices. So in the not too distant future, I suspect we'll start to see shippers having to raise their prices. We'll start to see other people then having to raise their prices to recover their margin, which again causes inflationary pressures. Does that sort of thing worry you as well?
The simple answer is yes. The more complicated answer is that there's always been stress, in the world.
But do you think something like that might just give the Fed pause to say, let's not go too quickly, let's not cut rates too quickly?
I'm hoping that the Fed's in a wait-and-see moment, that they continue to retain their independent thinking, and that they don't get forced by U.S. domestic politics as to speed the process up.
But if the Fed, that interesting situation, if the Fed is going to be deliberative and thoughtful, that implies that they're not going to rush to be cutting rates. But yet consensus market hope, I think probably markets are sort of pricing in the expectation there will be cuts. And so every time that you see a Fed governor say, well, let's not rush into this, markets start to get a bit queasy and a bit wobbly. So the very fact that if you're right in this postulation, that could have detrimental short-term consequences for market prices, because markets may go, this is not what we thought we were getting into. We thought this year was going to be a nice rosy one with interest rates being cut.
You're 100% correct. I think that the consensus last year, or at the end of last year, was we're going to have 5 or 6 rate cuts and away we go. Well, guess what? We're not going to. And I think you're now starting to see the governors, couch their words that we need to be certain that, inflation is, back under control for the extent that it can be. It never can be. It's we are at a point in time where we are a prisoner of some of our policies. Quite simply, if you want to have lower energy costs, then we, the U.S., has the ability to dramatically increase production. Well, we've been told not to. we as a country, the U.S. or whether it's Canada or whether it's Europe, we're more than well-equipped, or no, well-equipped's the wrong word. We seem to be passing our taxation on to the coffers that are in the Middle East. Take away the money. There is no conflict in the Middle East.
Yeah.
Just follow the money.
Yeah.
If you're paying $3.50 for gallon, and $2 of that is taxes, and we could have generated 20, 30, 40% more production, gas is at $2.
Yeah.
And then all of a sudden there's a whole lot less money going to the Middle East.
But that's not going to solve our short-term problem. That's a strategic longer-term perspective. So, but there is still the concern, though. Consensus is probably going to be. You're saying consensus is probably going to be wrong this year, which could have some short-term nervous moments for investors in equity markets.
Yeah, one of the things that I think most investors that have invested for a period of time are aware of is that markets will correct 5 or 10%. Mm-hmm. That's just normal. It happens once or twice a year, and if you were to
so don't be scared when that happens.
Yeah, don't be scared. But if you were to cut out those headlines and put them off to the side and look at them again a year from now, you'd start laughing because the world was coming to an end when it happened. But when you come out of it the other side, like where was it? And there's a short memory on it.
A lot of people get their financial news and their economic news from TV shows, the CNBCs of the world, the talking head type programs, and people, when they watch those, then come and speak to people like yourself and go, I'm worried about this or that. So going back to the human psyche part of it, should people not watch those sort of shows? What should people do to be informed but also not panicked by factors?
One of the best pieces of advice I received was to look at who the advertisers are. And once you can identify who the advertisers are, then you can see where the editorial slant is going to come in from whatever magazine you're reading, whatever radio show you're on, whatever TV program. So if you're watching CNBC, you can see that they have a slant, and you can just take a look at who their advertisers are, and then you can see where the slant is. I mean, they're in a business. They have to make money. They have to have revenues. Otherwise, they couldn't pay for everybody. So they have to have editorial content that will support their advertisers, and that is the key thing.
And I guess there's no point going on a TV show and saying, yeah, it's all right. Things are fine. You've got to be a little bit controversial. You've got to have some sort of edge just to make it sound a little bit more interesting sometimes.
I couldn't agree more. I stopped watching pretty much all of the business shows because there was just sensationalism.
Yeah.
It was just trying to get your eyeball to not leave the TV screen, and that leads to something called short-termism, and short-term decisions generally don't end well. And we need, to me, if you're investing properly, you need to have a long-term game plan, long-term decisions.
Quick 10 seconds, 20 seconds. How do we avoid short-termism? Just by avoiding watching these sorts of things? Or are there any other top tips you can give us for that?
Well, the next one's really hard because it is hard, and it's just thinking for yourself. It's one of the hardest things I have to do is to get away from group think.
So try not to be persuaded by the headlines, the noise, and just be self-thinking, and you're saying?
Yes.
Well, look, Richard, it has been a pleasure having you. You've been a star abandoning both the beach, the golf course, the stingrays, the turtles, all of the stuff that you could have been doing. Instead, you've come down to the radio studio this morning and subjected yourself to the torture that is Radio Cayman's Money Sense show. So thank you very much for joining us, Richard. It's been a pleasure having you with us.
Simon, I couldn't have thought of any other way to start my morning than the way that it has been today.
Well, there you go. And with those words ringing in my ears, if no one else's, thank you very much to all our listeners for tuning in to Money Sense, and please do rejoin us in 2 weeks' time.
Money Sense is brought to you by the Chamber Pension Plan. For further information, visit chamberpension.ky.
To keep our records up to date and to ensure seamless communication, the Cayman Islands Chamber of Commerce Pension Plan encourages you to review and update your beneficiaries and contact details, including your email and mailing addresses. You can update your contact information by logging into the member portal or by contacting us at 745-7630 or via email to admin@pensions.ky. Remember to act now to ensure we have the most current information for you. The Cayman Islands Chamber of Commerce Pension Plan. We're here.
When you're on the go, the experienced team at Foster's Pharmacy are here to help. Drop off your prescription while